Hello everyone, I am CA Pratik and in this video we are going to quickly revise the chapter 6A deductions, that is chapter 7 for the CA intermediate examinations. Okay, so first and foremost about the chapter 6A deductions, I would like to tell that none of the chapter 6A deductions are allowed if the assessee chooses the new tax regime under section 115 BAC. However, only two deductions is allowed, that is section 80JJAA, which deals with the additional employee cost, and 80 CCD subsection 2, which deals about the new pension scheme, etc. It is allowed as deduction even for the assessee if the assessee claims the new tax regime. Okay, now let us jump into the chapter. Firstly, deductions are of two types: payment based deduction and income based deduction. And in income based deduction also there are normal income based and certain income based deduction. Payment based deductions means what? Deductions is given based on the payment made by the assessee. Income based deductions means what? Deduction is given based on the income earned by the assessee. Okay, wow. Now, first point about deduction is that deductions cannot exceed the gross total income. So if the gross total income is 5 lakhs but the deduction to be allowed is 6 lakhs, then how much is the maximum that will be allowed? Answer is 5 lakhs, because the total deduction cannot exceed the gross total income. Next, deduction is allowed only to a single person and only once. So in many places we are going to see deduction is allowed for themselves as well as family members. So for example, if there is LIC deduction, life insurance policy, if it is allowed for self as well as spouse, okay, then on the same amount the assessee themselves and on the same amount the spouse also, both cannot claim the deduction. So deduction can be claimed only by one person for a single amount and only once. Okay, wow. I hope you are able to understand. Now, there is section 80AC. 80AC tells what, sir? No deduction is allowed, okay, under section 80IA to 80RRB. That is the income based deductions, etc. In your syllabus, it is 80JJAA, 80QQB and 80RRB. So, if a deduction is covered in the series 80IA to 80RRB, that is 80I, 80M, 80NOPQR. So, all these deductions will not be allowed as deduction if they are not claimed in the return of income before the due date to file the return of income. Okay, so only if it is the return of income is filed within the due date, then these deductions will be allowed, or else it will not be allowed. Next, sir, chapter 6A deductions is not allowed on special rate income like a long-term capital gain under section 112, then long-term capital gain under section 112A, then short-term capital gain under 111A, then if you are getting any winnings income under 115BB or any undisclosed income under section 115BBE, etc., then on such special rate incomes you will not get the benefit of chapter 6A deduction. So the total income you have to divide into two parts. The first part is the part on which you can claim the deduction. Second part is the part in which you cannot claim the deduction. So on which you can claim deduction, only against such income you should reduce the deductions and then add back the income on which you cannot claim the deduction. Okay, I hope you are clear with the concept. I explained this to you in class in detail. So next, payment based deduction. First deduction is what, sir? Section 80C. Very important, very important. Okay, section 80C is deduction is given for investment in some specified assets and it is given only to individual and HUF. Maximum 80C deduction limit is 1,50,000 rupees. Okay, first 80C deduction we are going to study is life insurance premium. Life insurance premium is allowed as deduction if the payment of premium is made for self or relative. Okay, wow. Self means the individual himself and relative means in case of individual it is spouse and children, and in case of HUF it is the members of the HUF. Okay, then life insurance premium is allowed only up to the limits. What are the limits, sir? If the insurance policy is taken before 1/4/2012, then the limit is actual premium or 20% of the sum assured, whichever is lower. If the premium is taken after 1/4/2012 between 31st of March 2013, then for all the life insurance policies it will be actual premium or 10% of sum assured, whichever is lower. However, if a life insurance policy is taken on or after 1/4/2013, then if it is a normal person, then the insurance premium allowed will be actual premium or 10%, whichever is lower. If it is a person suffering from disease specified under section 80 DDB or 80U, then it will be actual premium or 15% of the sum assured, whichever is lower. So these are the deduction limits. However, if the insurance contract got cancelled within 2 years, then the entire deduction allowed earlier should be converted to income and it will be deemed as income. Okay. Then we learned that receipts from life insurance policy, you get exemption under section 1010D. So if any sum or bonus is received from a life insurance policy, then the entire policy amount that is received will be exempt if the premium was within the limits. If the premium was not within the limits, then the entire amount is going to be taxable. However, exemption under 1010D is not available for two types of life insurance. Number one, if the sum is received by a person, if a sum is received for a person under section 80DD, okay, 80DD, not DDB, 80DD. And number two, if a sum is received from Keyman insurance policy, then that is also not exempt. Okay.
Later on, what happened? The Income Tax Act introduced a concept of ULIP, that is Unit Linked Insurance Plan or Unit Linked Insurance Policy. Okay, so in case of unit linked insurance policy, this is also not an amendment, this is an earlier provision only that I am taking, where if the premium is exceeding 2,50,000 rupees or if the aggregate premium was exceeding 2,50,000 rupees in case of more than one ULIP, in such case also such ULIPs will be fully taxable under the Income Tax Act. And now the Income Tax Act, that is section 1010D, has brought in another condition. What is that condition? Let us read. If any policy is issued on or after 1/4/2023, here you can write issued on or after 1/4/2023. Then first let us read the provision, then I will explain. Exemption would also not be available if the amount of premium payable exceeds 5 lakh rupees for any of the previous years during the term of such policy. In a case where premium is payable by a person for more than one life insurance policy other than ULIP and the aggregate of premium payable on such policies exceed 5 lakh rupees for any of the previous years during the term of any such policies, exemption would be available only in respect of those life insurance policy other than ULIP at the option of the assessee whose aggregate premium payable does not exceed 5 lakh rupees for any of the previous year during their term. So now a limit has been brought by the Income Tax Act in case of a normal life insurance policy also. And what is the limit? The limit of premium is 5 lakh rupees. So let me give you an example. Let's say there is a life insurance policy and the policy is issued on 1st of May of 2023. So is it after on or after 1/4/2023? Answer is yes. And let us assume that the sum assured is 1 crore rupees. Fine. And we will also, okay, let us keep the sum assured as 40 lakhs for the time being. 40 lakhs. Okay. And the premium payable every year rupees 6 lakhs. Sum assured is how much? 40 lakhs. And premium is how much? 6 lakhs. Fine. Okay, we'll keep the sum assured as 1 crore so that you will not get confused with other section. Right? So sum assured is how much? 1 crore rupees. Premium is how much? 6 lakh rupees. Now what is the percentage? The percentage is actually only 6%. You get my point? 6% is the premium. So is it within the limits? Answer is yes, it is within the limits that we discussed earlier. So according to the earlier provisions, this entire 1 crore, if it is received by the assessee, it will be completely exempt from tax, or whatever maturity amount is there will be completely exempt from tax in under section 1010D. This was the earlier provision. But now what has happened? Now this 1 crore rupees has become taxable. Why it has become taxable? Because the premium is more than 5 lakh rupees. You get my point? Hence, the maximum premium, life insurance premium, can only be 5 lakh rupees. If the life insurance premium is more than 5 lakh rupees, in that case also, the entire maturity amount is going to be taxable. You get my point? Similarly, sir, what if there is more than one policy? Let us assume that there is a person, Mr. P. Mr. P is having 3 life insurance policies: policy 1, policy 2, and policy 3. Okay. Let us assume for the time being that all these policy premiums are within the limit which is specified already. Okay, that is the 80C limits. Now we are only going to discuss the 5 lakh concept. The premium for policy 1 is coming to 2 lakh rupees. The premium for policy 2 is coming to 3 lakh rupees, and this premium for policy 3 is coming to 4 lakh rupees. Okay. Let us also assume that sum assured for this 2 lakh policy is 1 crore. Sum assured for this 3 lakh policy is rupees 2 crore, and sum assured for this 4 lakh policy is rupees 10 crores. Okay. So premium is given, sum assured is given. Now see here, Kanna, for any of the policy is the premium exceeding 5 lakh rupees? Answer is no. The premium is within 5 lakh rupee range, and also the premium is within the range that we had discussed in section 80C, that is 10% or 15% as the case may be. In both cases it is within the limit. So in all the cases it is within the limit. However, see here, the total premium is how much? Total premium is 2 plus 3 plus 4, which is 9 lakh rupees. Total premium is how much? 9 lakh rupees. Since the total premium is 9 lakh, which is more than 5 lakh, still the life insurance policy maturity or any amount received from the life insurance policy will be taxable. However, in such case, the assessee is having an advantage. What is the advantage? The assessee can choose which all policy he wants to get exempted, and the amount of premium of such policy should be within 5 lakhs. So for example, I can choose that I will exempt policy 1. If I exempt policy 1, then what will happen? 3 lakhs plus 4 lakhs will be 7 lakhs. So this entire amount will be taxable. Correct? I can also choose that I will get an exemption for both policy 1 as well as policy 2. For policy 1 and policy 2, what is the premium? The premium is 5 lakh rupees. Is 5 lakh within the limit? Answer is yes. So I can choose that policy 1 and policy 2 I will claim an exemption, since both combined the premium is within 5 lakhs, and I will treat policy 3 as taxable policy. You get my point? Now there is one more option. I can choose policy 3 as exempt. Since the premium of policy 3 is within 4 lakh rupees, but if I choose policy 3 as exempt, then policy 1 and policy 2 both will become taxable. Both will become taxable. Listen very carefully, this is very important concept. Both policy 1 and policy 2 will become taxable. Okay. Now what is the most beneficial for the assessee? Should the assessee choose policy 1 plus policy 2, or should the assessee choose policy 3 as exempt? Answer is, in this case the assessee should choose policy 3 as exempt, because the sum received from life insurance policy is going to be how much? 10 crores. Whereas in case of policy 1 and policy 2, both combined also you are going to get only 3 crores. Okay. So choose this 10 crores as exempt, and on this 3 crores which is possibly going to be received, make it taxable and pay the tax, if at all an amount is received from life insurance company. You get my point? So like this, if the amount of premium aggregate is more than 5 lakhs, then the assessee can choose the premium up to 5 lakh rupees to be exempt. Such policies will be exempt and the remaining policies will become taxable. You get my point? I hope it is crystal clear. Now let us discuss how will it be taxed. First let us also go through the other provisions quickly. These are all old provisions only. This section will not apply to sum received by any person under 80DD and Keyman insurance policy. Keyman insurance policy we had discussed already. It is taxable under 3 heads of incomes based on the situation. So it is not covered under 1010D exemption. Then there is ULIP, which we had already discussed before itself. If ULIP, if the policy premium is more than 2,50,000 and aggregate is also more than 2,50,000. The same concept as we discussed right now, it also applies for ULIP, and in case of ULIP, the maximum limit is how much? 2,50,000. Fine. And in all the cases, if at all the amount from life insurance policy is received on death, then it is fully exempt. You get my point? So if amount is received on death, you need not see any condition at all. It is fully exempt. If other than death only, you have to see all these conditions. Fine. Now let us learn the new section that has come under income from other sources chapter, which is relating to this life insurance policy, which is nothing but section 56 to 13. Sum received by way of bonus from life insurance policy other than ULIP and Keyman insurance policy, which was not exempt under 1010D. Let us study the provision. So where any sum is received, including the amount allocated by way of bonus at any time during the previous year under life insurance policy other than the sum received under ULIP or Keyman insurance policy that is not exempt under 1010D, the sum so received as exceeds the aggregate premium paid during the term of such life insurance policy and not claimed as deduction under the provisions of the Act, computed in the prescribed manner, would be chargeable to tax under the head income from other sources. So basically, whatever policy, okay, which is not a ULIP and not a Keyman insurance policy and also not exempt under section 1010D will be taxable under income from other sources under this new section called 56 to 13. Okay. Now how to calculate the tax? First and foremost, you have to see whether the amount is exempt or not. If you have found out that the amount is not exempt, then you have to find out under which section it will be taxable. If it is falling under this section, that is 56 to 13, in such case, how to find out the income? The income is nothing but total amount received from the policy, including bonus, minus premium paid, the premium that you have already paid, on which deduction was not claimed. Premium paid on which deduction was not claimed. Because if you reduce the premium paid on which you had claimed the deduction already, then there is no point in reducing from the total amount because you have already taken benefit of that premium. So only the premium paid on which the deduction was not claimed can be reduced from the total amount. So let me take an example, Kanna. There is a life insurance policy. Okay. Premium is equal to 10 lakhs. And let's say sum assured is 50 lakhs. Sum assured is how much? 50 lakhs. And also maturity amount. Maturity amount is 50 lakhs. For simplicity's sake, we will keep the maturity amount also same. Now this premium of 10 lakhs is nothing but 2 lakhs multiplied by 5 years. For 5 years premium was paid and the total premium was 2 lakh rupees. Okay. Now look here, Ganna. Is this 2 lakh amount? Okay, in this case, this entire policy is exempt. I will change the sum a little bit. Let us keep this as sum assured as 15 lakhs and maturity amount also 15 lakhs. Okay. Now listen here. Is this 2 lakh amount within 10%? Answer is no. It is more than 10%. Hence this policy is taxable. 15 into 10% is how much? 1.5 lakhs. So what should be the maximum premium? The maximum premium should only be 1.5 lakhs. However, the premium is how much? 2 lakh rupees, and that is why what will happen? This entire policy is not exempt under 1010D and it will be taxable. Now how to find out the tax? Let us see. Now in case of this policy, every year will the assessee have claimed deduction under section 80C? Answer is yes. Let us assume that every year the assessee claimed 1.5 lakhs as deduction, because maximum how much it is allowed? 1.5 lakhs only maximum allowed. So 1.5 lakhs into 5 years is equal to 7.5 lakhs. You get my point? So here, now let us calculate the income. Income under section 56 to 13. In this case, income is equal to maturity amount minus premium not claimed as deduction. So what is the maturity amount? 15 lakhs. And what is premium not claimed as deduction? Total premium is 10 lakhs, out of which 7.5 lakhs was claimed as deduction. So balance 2.5 lakh rupees is the premium not claimed as deduction. So here 15 lakhs minus 2.5 lakhs, answer is the income will be 12.5 lakhs. So this 12.5 lakhs should be added to income from other sources. You get my point? So I hope now you are clear how to find out the income from other sources, how to calculate the income under section 56 to 10. If you want, you can pause the video and note down this example. Fine. Now you can unpause the video. Now for you, I have made a separate special table by which you will be crystal clear how you should tax any life insurance policy. So first I want you to note down this table. I think 1 page space you have at the end of income from other sources chapter. In this page you can note down. Fine. Please pause the video and note down the table. Copy down this table in the page that is available. Then unpause the video. Done. Next. Please copy this part. Done. Now please copy this part, pause the video and finish copying. Done. Now lastly, please copy this part. Finished? Right. Now let us discuss this table. So what you have to do, if there is any life insurance policy, first you have to check whether the policy is within the limits specified under 80C. Okay, so if the policy is issued before 1/4/2012, it should be within 20%. The premium should be within 20% of sum assured. If it is 1/4/12 to 31/3/13, then 10%. And if it is issued on or after 1/4/2013, then in normal cases 10%, in disease case it is 15%. If the conditions are not satisfied, if the policy premium is more than the limit, then what will happen? Then the life insurance policy is taxable. Correct? It is not exempt under 1010D. If it is a ULIP, then it will be taxable under capital gain chapter, section 112. However, it is not covered in your syllabus, it is covered in CA final syllabus. So need not worry about that. If it is other than ULIP, then it will be taxed under section 56 to 13. We had just discussed this example a few minutes back, correct? Other than ULIP, it will be taxable under 56 to 10. Now let us assume that the limits condition have been satisfied. Okay, if it is satisfied also, we have to see whether the policy was a ULIP or other than ULIP. In case of ULIP, you have to see whether the policy was issued before 1/2/2021. In such case, it will be exempt under section 1010D. If the policy is issued on or after 1/2/2021, then aggregate premium within 2,50,000 will be exempt and aggregate premium above 2,50,000 will be taxable. Correct? If the aggregate premium is above 2,50,000, then you can choose certain policies, the total premium of which should be within 2,50,000, that can be claimed as exemption, and remaining policies will be taxable under section 112A. Okay, and this is also a part of CA final syllabus. It was removed from CA inter syllabus, so not a problem for you. Now let us discuss about the other than ULIP. In case of other than ULIP, I'm sorry, here you have to make a small change. If the policy is issued before 1/4/2023, then it will be exempt under section 10D, and if the policy is issued on or after 1/4/2023, then if the aggregate premium is within 5 lakh, it will be exempt under section 1010D. If it is above 5 lakhs, then you have to choose the policies whose aggregate premium is within 5 lakhs. That will be exempt under section 1010D, and remaining policies will be taxable under section 56 to 13 as we discussed above. I think here equal to symbol is there. Let me just check this once. Just a second. Exceed. So here one more small change I would like you to make. If the aggregate premium is greater than 5 lakhs, and here you put equal to symbol. Fine. Less than or equal to 5 lakhs, remaining policies. And above also, I want you to make a small change. Aggregate premium is less than or equal to 2,50,000. In such case, no problem. If it is greater than 2,50,000, then policy is chosen. Here also you can write equal to symbol. Up to 2,50,000 exempt, more than 2,50,000 taxable. So this small change only. Now let me summarize once again, very important. So what you have to do, if you have a life insurance policy, you have to check whether it is within ATC limits. If it is within ATC limits, then only you have to proceed further. If it is not within ATC limits, then directly you know that it is taxable and you have to kandupudichify, or you have to find out the tax. Now, sir, what if it is within ATC limit? Then you have to check whether it is a ULIP or not a ULIP. If it is a ULIP, then 2,50,000 you have to see the limit. If the total premium is within 2,50,000, it will be exempt. More than 2,50,000 will be taxable under section 112A. Now let us talk about other than ULIP policy. If the policy is issued before 1/4/2023, then however it will be exempt. If it is on or after 1/4/2023, then if the aggregate premium is within 5 lakh, it is exempt. If it is above 5 lakh, then up to 5 lakh you can claim as exemption. The remaining policies will be taxable under section 56 to 10. Got my point? 25 minutes discussion we have had on this topic. I hope you are crystal clear with the concept.
Now let's come to payment of tuition fees. Payment of tuition fees, okay, it is allowed only for maximum 2 children, okay, of an individual. Second, payment of tuition fees only is allowed, any other fees is not allowed. So for example, if any payment is made to a school or college, there will be many parts in the payment like lab fees, okay, donation, library fees, etc, etc. In that only the tuition fee component will be allowed as deduction, the others will not be allowed as deduction. Next, payment should be made to School, college, university or other institution. Private college not allowed. Private tuitions not allowed. Sorry. Private college illa. Private tuitions not allowed. Next, only if the institution is in India, then it is allowed as deduction. So if I send my children to abroad to study, then the tuition fees paid abroad will not be allowed as deduction. Okay. And remember, tuition fees is allowed only for children. Even if the assessee pays tuition fee for himself, it will not be allowed as deduction. Fine. Now let's come to repayment of housing loan, stamp duty, etc. Okay. Sir, interest on housing loan is allowed as deduction under house property chapter under section 24B. However, the repayment of housing loan is allowed as deduction under section 80C. Okay. But there are some conditions. First condition is that the loan should be taken for the purchase or construction of the house, not for repair, maintenance, etc. And the house should be a new residential house property. What's a residential house property? And the loan should be taken only from financial institutions, etc. Okay, the list is given. You can read the list. However, if you see in house property chapter, the housing loan can be taken from anyone. Still the interest is going to be allowed. But in deduction chapter, only if you take it from the specified persons, then only the repayment is going to be allowed as deduction. Okay. So this was about the housing loan repayment. Now next, if any stamp duty or registration fees or any other expense is paid for the purpose of purchasing a house, then such amount will be allowed as deduction. However, please note, for this repayment of housing loan and also for stamp duty, registration fee, etc., there is one more condition, that the house should be there for at least 5 years. If the house is transferred within 5 years, then the entire deduction allowed earlier will be deemed as income. Fine. Now let's come to next point. Any contribution to statutory provident fund, recognized provident fund or public provident fund, and even approved superannuation fund. So all of them will be allowed as deduction under section 80C. This we have already discussed when we were seeing the salary chapter. Okay. However, when it comes to contribution to public provident fund, that is PPF, deduction is allowed if it is for self, and also it is allowed for family, and family is same as the family definition in life insurance premium, that is spouse and children. Remember, there is no dependent concept, only spouse and children. They can be dependent or independent, it does not matter. Fine. Next, 5-year term deposit. So 80C wherein what else deduction is there? If a person deposits in a 5-year term deposit, for example a 5-year tax saving fixed deposit in a bank or scheduled bank or post office, then such amount can be allowed as deduction. However, if the amount is withdrawn within 5 years, then the entire deduction allowed earlier will be deemed as income. Next, contribution to additional account, that is tier 2 account under NPS, new pension scheme. Now the deduction for the NPS is allowed under section 80 CCD. However, only and only for central government employees, okay, they have the facility to deposit in tier 2 account of the NPS. If they deposit in tier 2 account for the period of 3 years or more, then they will get deduction under section 80C. Okay, 80C. That is in this section. Then what are the other accounts where deduction is allowed under section 80C? First, approved superannuation fund. Then next, unit linked insurance plan, that is ULIP of a mutual fund or LIC. Okay. Then notified pension scheme of mutual fund or UTI. Then approved annuity plan of LIC. Sukanya Samriddhi Yojana. Then senior citizen savings scheme. Then any amount contributed to National Housing Bank. Then if you subscribe National Savings Certificate, that is NSC, then also you get deduction. You get deduction also for the interest on NSC. So if interest is received on NSC, first put it in the income column, that is income from other sources, and then you can claim it as deduction under 80C also. Then notified unit of mutual fund or UTI. Certain equity shares or debentures with the lock-in period of 3 years, if you are taking, then also you can get deduction. Then certain units of mutual fund. Then deposit scheme of a public sector undertaking or any authorities engaged in housing finance for residential houses, example HUDCO. Okay. then any notified bonds of NABARD, any premium paid for a deferred annuity contract, or any salary deducted by government employer for deferred annuity. So all these amounts are allowed as deduction under section 80C, subject to a limit of rupees 1,50,000, and the amount is allowed only for individual and HUF, and in certain cases for the relatives also. Okay, so I hope you are clear with 80C. See the list thoroughly so that when it is mentioned in the exam you are able to answer easily. Next, section 80CCC, 80CCC, that is contribution to pension fund of any insurer. For example, LIC. So if a person is contributing to the pension fund of any insurance company, then such contribution will be allowed, okay, to an individual up to a maximum of 1,50,000. Maximum 1,50,000. Remember carefully, contribution to pension fund of insurer is coming in 80CCC. Contribution to pension fund of mutual fund or UTI is coming in section 80C. Okay, pension fund of this one. Notified pension fund of mutual fund or UTI comes under 80C, and pension fund of any insurer comes under section 80CCC. Here also the limit is 1,50,000. Okay, and pension fund la only HUF can put the HUF cannot put the amount, so it is allowed only for individual. Now see, there is also another section called 80CCE. Okay, which is putting limit over limit. What is that section? The section is telling 80C, 80CCC, 80CCD subsection 1. Repeat again, 80C, 80CCC, 80CCD subsection 1. All these three sections combined, the maximum limit is only 1,50,000. So in 80C the limit is 1,50,000. In 80CCC the limit is 1,50,000, and in 80CCD there is another limit, that is salary or 10%, whichever is lower, which we are going to study. All these three combined also, the maximum deduction that can be claimed is 1,50,000. Okay, so be careful. There are separate limits under all the three sections, and combined limit is 1,50,000. Okay, now let us see section 80CCD. 80CCD section gives the deduction to the assessee for the contribution to the pension fund of central government or Atal Pension Yojana or new pension scheme, which is also called National Pension System Trust. Okay, so in 80CCD there are three subsections: 80CCD subsection 1, 80CCD subsection 1B, and 80CCD subsection 2. 80CCD subsection 1 alone, it is included in 80CCE limit of 1,50,000. 80CCD 1B and 80CCD subsection 2, it is separate from the 80CCE limit, which means it can be claimed additionally. First, let us talk about 80CCD subsection 1. 80CCD subsection 1 is allowed only for the employee contribution to the pension scheme. Okay. If the employee contributes to the pension scheme, then 10% of the salary or the actual employee contribution, whichever is lower, will be allowed as deduction. Okay, what is the meaning of salary, sir? Salary means basic plus DA terms, that is the dearness allowance which forms part of retirement benefits. However, sir, is it possible that a person who is not in salary, okay, so who is not having employer-employee relationship, can such person also contribute to NPS? Answer is yes. So if a person other than a salaried employee, if such person contributes to NPS, that is National Pension System Trust or new pension scheme or Atal Pension Yojana, etc., then such person will get the deduction of 20% of the GTI, that is gross total income, or the actual contribution, whichever is lower. Fine. Next, there is section 80CCD subsection 1B, which is also for employee contribution. Okay, and the maximum limit is 50,000. So 80CCD 1 also employee contribution, 80CCD 1B also employee contribution. Okay, and nowhere it is mentioned that 80CCD 1 should be claimed first and 1B should be claimed second. Hence, you can claim it in any order. Okay, so hence, if there are so many deductions and 80CCD 1B is also available, then claim 80CCD 1B first and then claim 80CCD subsection 1, so that you can get the maximum benefit. Okay, Next, sir, section 80 CCD subsection 2, it is available for employer contribution. If the employer is a central government employer, then the maximum employer contribution allowed as deduction is 14% of the salary. So hence deduction will be 14% of salary or actual employer contribution, whichever is lower. Then if it is other than government employer, then the maximum deduction will be 10% of the salary. Hence the deduction will be 10% of the salary or actual employer contribution, whichever is lower. Okay. And sir, what is special about 80 CCD subsection 2? 80 CCD subsection 2, it is also allowed, as I told you earlier in the starting of the chapter itself, it is allowed for the people who are opting for the new tax regime under section 115 BAC also. So that is some special point. And one more special point is that for this employer contribution, the employer is going to get the deduction under PGBP chapter under section 36. Okay, there also the limit is the same, 10% of the salary or actual employer contribution, whichever is lower. Here also salary means basic plus DA. There also DA terms. There also salary means basic plus DA terms. Okay. So in PGBP, the employer is going to claim the deduction. Under deduction chapter, that is chapter 6A deductions, the employee is going to claim the deduction. Okay. So if there is any employer contribution, first that employer contribution should be added to the salary and then you can claim it as deduction under chapter 6A deductions.
In section 80 CCD subsection 2, we learned that in case of a central government employee, the limit is 14% of salary for employer contribution. Now there is a small change that other than central government, even for state government employee, the limit is 14% of salary. You get my point? So now both central government as well as state government employees can take the benefit of higher limit of 14% of salary in case of employer contribution. Fine.
Then next, if any pension scheme is converted to annuity plan, then there will not be any tax on such conversion. However, if such annuity plan is closed or opted out, or if you receive any pension from the annuity plan, then it will be deemed as income. Then what about closure of pension scheme, sir? If the pension scheme is closed, then the amount received from the pension scheme, 60% will be exempt, 40% will be taxable. Okay. However, if the receipt of the pension scheme, it is received by the legal heir of the person who is dying. If the person has died and the legal heir is receiving the money, then it is fully exempt in the hands of the legal heir. Then section 1012B, section 1012B, if an amount is partially withdrawn from the NPS, okay, then if the withdrawal amount is up to 25% of the total employee contribution, then the withdrawal is fully exempt or else it will be taxable. Okay, next. I also told, if any recognized provident fund or approved superannuation fund, if the amount in the recognized provident fund or approved superannuation fund, if it is transferred fully to NPS, then there will be no tax on such transfer. Fine. Then 80 CCE limit we have already studied. Now let us come to very important section 80D, that is medical insurance premium etc., and it is allowed for individual as well as HUF, individual as well as HUF, and it is allowed for relatives also. Who are the relatives, sir? Self, spouse, dependent children and parents. Self, spouse, dependent children and parents. Okay, wow. So parents need not be dependent. However, children, it is allowed only if they are dependent on the assessee or individual. Okay. Now for HUF, the relative means members. So if the HUF takes any medical insurance premium for the members, it will be allowed as deduction. Okay. Maximum deduction is 25,000. However, for an individual, there are two maximum limits. First limit is given for self, spouse and dependent children. Second limit is given for the parents. So 25,000 limit for self, spouse, dependent children. 25,000 limit is for parents. Okay, so total how much? 50,000 is the maximum. However, if any one of the persons, if it's a senior citizen Okay, if it is a senior citizen and his amount is spent on senior citizen, then the maximum amount is increased to 50,000 rupees. So if individual himself is a senior citizen, then maximum amount will be 50,000, or if one of the parents is a senior citizen, then the maximum amount will be 50,000 in such case. Okay. Okay, so maximum amount will be 50,000 if there is a senior citizen. Similarly, even in the HUF, if one of the members is a senior citizen, the maximum amount for the HUF will be 50,000. Now let us see what and all expenses are allowed as deduction. Firstly, if any medical insurance premium is paid, okay, it is allowed as deduction. Next, if any amount is contributed to central government health scheme or contributory health service scheme, it is allowed only for the individual, and it is allowed only if it is contributed for self, spouse and dependent children. It is not allowed if it is for parents. Okay. Then preventive health checkup is also allowed as deduction. Preventive health checkup is also allowed as deduction. However, the maximum preventive health checkup allowed is 5,000 rupees, and this 5,000 is included in the above limits that we discussed above. So you should see that limit also, that is 20,000, 50,000 as the case may be, and you should also see whether this 5,000 limit is satisfied, and this 5,000 is the total limit, that is for individual, self, dependent children as well as parents. So everyone combined maximum preventive health checkup is 5,000 rupees that is allowed. Okay. And I told you that any payment that we discussed in this deduction should be made in any mode other than cash. It should be made in any mode other than cash. However, preventive health checkup, it is allowed even if it is paid through cash. Preventive health checkup is allowed even if it is paid through cash. Now one more special point, sir. If there is a senior citizen and mediclaim is not available for the senior citizen, then even medical expenses will be allowed as deduction. Even medical expenses will be allowed as deduction. Okay. However, there is no separate limit for this medical expenses. It is included in the above limit of 25,000 or 50,000 as the case may be. Fine. Now, there can also be a situation where a lump sum amount of medical premium is paid for multiple years together. In such case, the premium allowed as deduction will be total premium divided by the number of years. So whatever the answer will be allowed as deduction. So if 80,000 rupees is paid as premium for 4 years, then 80,000 divided by 4, that is 20,000, will be allowed as 80D deduction in 4 years period. Okay, every year it will be allowed as deduction for 4 years. I hope you are clear with this concept. And this preventive health checkup 5,000 etc., only if you are able to solve the question, you will be able to appreciate the section. Okay, so please solve the questions after this. Now let us see 80G deduction. 80G deduction is given for the donation. It is allowed for all the SSEs. It can be AOP, BOI, company, whomever it is. 80G donation is allowed as deduction. Okay. However, in 80G there are four types of donation. Four types of donation: 100% unlimited, 50% unlimited, 100% limited, 50% limited. Okay, so 100% unlimited category, in such category you will find all these types of organization: PM National Relief Fund, PM Armenia Earthquake Relief Fund, CM Relief Fund, Andhra Pradesh CM Relief Fund, National Children Fund, Defense Fund, etc., etc. So I have given you some keywords to identify what comes under 100% unlimited category. So if you find the wordings like PM or CM or national or state or army, defense, clean Ganga, Swachh Bharat, then all these types of organization are covered in 100% unlimited category. 100% unlimited category. Sir, 100% unlimited means what? It means whatever amount is donated to such organization, the entire amount will be allowed as deduction under section 80G. Okay, whatever amount is donated, entire amount will be allowed as deduction. There is no limit, no nothing. Now let's come to, and here there is also an amendment. Okay, be careful that PM Cares Fund. PM Cares Fund is now included as a new option under 100% unlimited category. Now let's come to 50% unlimited category. In 50% unlimited category, there are 4 organizations: Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, Rajiv Gandhi Foundation, and Prime Minister Drought Relief Fund. So Jawaharlal Nehru's daughter Indira Gandhi's son Rajiv Gandhi. So all these three plus Prime Minister Drought Relief Fund. So if you find the keyword as Prime Minister, only Prime Minister Drought Relief Fund is covered in 50% unlimited. All the other Prime Minister Fund will be covered in 100% unlimited category. Sir, 50% unlimited category means what? It means whatever amount of donation is donated to such funds, 50% of such amount will be allowed as deduction under section 80G. So even if I donate 1 crore rupees, 50 lakh rupees, that is 50% will be allowed as deduction. There is no limit for the amount of donation to be made. However, now let's come to the limited category. Limited category means what? The donation should be within the limits. The donation should be within the limits. So what are all covered in limited category? Let us see. First, let us see 100% limited category. 100% limited category, who and all are covered? There are two points. First point, government or any approved local authority for the purpose of family planning, promotion of family planning. Okay. Then second, any sum paid by a company as donation to Indian Olympic Association or any other association or institution as may be notified by the government for the development of infrastructure for sports or games or for the sponsorship of sports or games in India. I have given you the keywords family Olympics. So if it is for family planning or Olympic sports etc., then it is covered in 100% limited category. 100% limited category. So it means the 100% of the donation is allowed as deduction. However, the amount of donation should be within the limits. Now let us see 50% limited category. In 50% limited category, there are 5 points. First point, any institution or fund established for charitable purposes. Number 2, government or any local authority for utilization for any charitable purpose. Okay, other than family planning. If it is for family planning, it is covered in first point. That is 100% unlimited category. Then third one, any authority constituted in India for the purpose of housing accommodation, okay, or for the purpose of planning, development or improvement of cities, towns, villages or both. So basically for housing. And number 4, any corporation established by central government or state government for promoting the interest of minority community. Then number 5, for renovation or repair of temple, mosque, gurudwara, church or any other place of historic archaeological importance. So basically I have given you the keyword charity in temple and housing for minority. Charity in temple and housing for minority. That is the keywords are charity, temple, that is temple, mosque, gurudwara, church, historical importance etc. Then housing and then minority community. If one of these keywords are coming in the institution name, it means it is covered in 50% limited category. 50% limited category. It means that the 50% of the donation is allowed as deduction. However, the donation should be within the limits. Okay. Now, what is the limit? Let us see. Firstly, to find the limit is what, sir? Limit is 10% of adjusted total income. The limit is what, sir? 10% of adjusted total income. How to find adjusted total income? This adjusted total income is different from the adjusted total income that we study in 115JC, that is AMT. Okay, this is different, that is different. So how to find adjusted total income? Gross total income minus chapter 6A deductions except section 80G. Okay, and you should also reduce short term capital gain under 11A and long term capital gain under 112 and 112A. So all these after reducing it, you should also reduce if there is any 115BB income or 115BBE income, that also you reduce. Okay, after reducing all this, the amount you get will be called adjusted total income. Okay, you should take 10% of adjusted total income. Then step number 3, you should take sum of all the limit based donation. Sum of all the limit based donation. Then permissible donation will be adjusted total income, that is 10% of adjusted total income or actual donation, whichever is lower. How much is allowed, sir? 10% of adjusted total income or actual donation which is in the limited category, whichever is lower. Okay. Now, when you find the total donation that is permissible, you have to give the first rank, that is first priority to the 100% donation category, and then second priority to the 50% category. Okay. Here you have to be very careful that this limit is only for the amount of donation and not for the amount of deduction. So total donation should only be 10% of adjusted total income. So let's say if the total donation allowed is 1 lakh rupees, then you should give the first priority to the donation which is made to 100% category, second priority to the 50% category. So whatever there is in 50% category, you should take 50% of such amount. I would recommend you to solve the question so that you do not make silly mistake in the exam hall. Okay. Next, no deduction is allowed if cash payment is above 2000 rupees. Cash payment is above 2000 rupees, then deduction will not be allowed. And if donation is made in kind, then also the donation will not be allowed as deduction.
Very small change, easy change, that in this 50% unlimited deduction category, what you have to do, three funds have been removed in the act. Which are they? Nehru family, Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, and Rajiv Gandhi Foundation. So if now donation is made to these funds, no deduction will be available, right?
Sir, in many places we are seeing that the payment should be other than cash. In 80D also we saw that the payment should be in other than cash. Here also maximum cash payment is 2000. So similarly, in all the chapter 6A deduction, you will be finding the wordings as any mode other than cash. So even bearer check is allowed, okay, even crossed check is allowed. All these modes are allowed, only cash is not allowed. Okay. However, only in 80JJAA, only in 80JJAA, that is additional employee cost, you will find the wordings as account pay check, account pay bank draft, electronic clearing system, or any other prescribed mode. It means that if you are claiming deduction under 80JJAA, then you should only pay via prescribed modes. However, for the other deductions, wherever such condition is mentioned, if you are paying through any mode other than cash, it will be allowed as deduction. So this, it will help you to differentiate and it will help you to remember when you prepare for exams. Next, section 80DD. DD means what, sir? DD means disabled dependent. DD means disabled dependent. So this deduction is allowed to individual and assessee, not for themselves. It is allowed only if they are incurring any medical expenditure, okay, medical expenditure or any other expenditure like depositing in insurance, etc., for the purpose of their dependent relative. It is allowed to whom? It is allowed to individual or HUF if they are incurring any medical expenditure or they are depositing any amount for the purpose of their dependent relative. Sir, who is covered in relative definition? For individual, the relative means spouse, children, parents, brothers and sisters. Spouse, children, parents, brothers and sisters, and for the HUF it is the members, and the relative should be dependent on the individual. Okay, so remember that point. The condition is the assessee should incur any medical expenditure. It can be even for 10 rupees or 100 rupees or 1 lakh rupees, whatever it may be, any medical expenditure. Or if you are not incurring the medical expenditure, deposit any amount, okay, for the purpose of the dependent relative. It can be for insurance premium also. Now, if the disabled dependent relative is suffering from a normal disability which is mentioned under section 80U, okay, normal disability, then the deduction will be flat 75,000 rupees. Okay, be very careful, not 75,000 or actual expense, whichever is lower. Flat 75,000 deduction. It means whatever expenditure it may be, you ignore it. You just take 75,000 and put 75,000 as deduction. And in case the disabled dependent relative is suffering from a severe disability means what? 80% or more organ damage. In such case, flat 1,25,000 will be allowed as deduction to the assessee irrespective of the expenditure incurred. Okay.
we saw that there are two conditions. Either of two conditions should be satisfied. So either medical expenditure should be incurred, or condition number 2, deposit should be made for the maintenance of such dependent relative. Okay. So now what is this deposit, sir? Listen here. For example, there is a person, Mr. A. Okay. And he has a disabled dependent, Mr. D. Mr. D is a disabled dependent relative of Mr. A. So what should Mr. A do? Mr. A should deposit money in a fund. Okay. If Mr. A is depositing any amount of money in the fund for the maintenance of this dependent disabled relative, in such case Mr. A will get the benefit of the deduction. Fine. Now what are the rules, Kanna? The rules is that from this fund money cannot be given to Mr. D until death of Mr. A or till the time Mr. A attains 60 years of age. So what did I say? Mr. A should keep depositing money in a fund. From that fund, that deposit fund, no benefit should be given to the dependent disabled relative till the death of Mr. A or the time when Mr. A receives 60 years of age. You get my point? If at all Mr. D is receiving the money from the fund before the death of Mr. A or before Mr. A receives 60 years of age, whichever is earlier, then entire amount of deduction allowed will be taxable. In such case, entire deduction that was allowed earlier will become taxable. If not, then no problem at all. If Mr. A attains 60 years of age or if there is death of Mr. A, then the money from this fund can be given to the disabled dependent relative. So what is the logic of this section? The logic is that till Mr. A attains 60 years of age, obviously Mr. A can take care of this relative, correct? So no problem at all. After Mr. A attains 60 years of age, then Mr. A will not be able to help. Hence, the money can be given from the fund to the disabled dependent relative and the disabled dependent relative will be able to manage and survive. So that is the concept.
Next, section 80U. Section 80U, section 80DD we studied, it is for dependent relative. Okay, dependent relative. However, 80U is for the assessee himself. So only individual can claim section 80U. Okay, then all the other conditions are same as 80DD. The individual should incur any expenditure on himself for the purpose of medical treatment or deposit any amount for himself. Second, if the individual himself is suffering from normal disability mentioned under 80U. What is disability mentioned under 80U? Disability means any disease specified in Persons with Disability, Equal Opportunities, Protection of Rights and Full Participation Act 1995. You need not focus much on this. If it is coming in exam, it will be given that it is specified under 80U. Okay, so don't worry that much. So if the individual is suffering from the disease, if it is a normal disability, 75,000 allowed as deduction. If it is a severe disability, that means 80% or more organ damage, then 1,25,000 rupees is allowed as deduction. So for individual himself, he can claim under section 80U, and for the individual for the purpose of their dependent relative, they can claim under section 80DD. 80DD. Okay, you get my point? Now let us come to section 80DDB. 80DDB is deduction for medical treatment of specified diseases. Medical treatment of specified diseases. Who is eligible, sir? Individual HUF are eligible, and same section is used for individual themselves as well as their relatives. Themselves as well as relative. Relative definition is same as section 80DD. What is the deduction allowed? Deduction allowed is actual expense incurred for medical treatment, or 40,000 in case of normal citizen or 1 lakh in case of senior citizen, whichever is lower. and from this lower amount you should reduce any insurance claim that is received or any reimbursement that is received by the employer from the employer. Okay, so this you should reduce from the amount. The balance amount will be allowed as deduction. Okay, one more condition, medical prescription is compulsory for the disease. Now let me tell you one special point. Okay, that this dependent word is used only in the relative definition in section 80D series, that is 80D, 80DD and 80DDB. Okay, in all the other sections, if at all there is a relative definition, in such relative definition you will not find dependent word in it. Okay, so for example in LI's life insurance policy, what is the relative definition? Spouse and children. Okay, you will not find the word as dependent spouse or dependent children in the definition. Hence, in exam, for any deduction other than 80D series, if you are getting the wordings in the question as dependent children, dependent parents, etc., just ignore it. Okay, and just see whether they are in the relative definition or not. In question, they will give you dependent only to confuse you. Okay, they will also give you minor children, major children, etc. That will also be given to confuse you, because in deduction chapter there is no minor major concept. Okay, so be careful while learning and keep all these tips in mind. Next, section 80E, interest on loan for higher education. Who is eligible, sir? Individual. So if an individual takes a loan for the purpose of higher education means what? Education after class 12. Okay, for the purpose of self, spouse, children or student for whom he is a guardian. Who's a self, spouse, children or any student for whom the assessee is a guardian. If the assessee takes a loan for the purpose of higher education, and the loan should have been taken from a financial institution or charitable organization under section 80G, then the interest on loan is allowed for a period of 8 years or the actual period for which the interest is paid, whichever is lower. Okay, maximum 8 years the interest paid is allowed. Next, let us come to section 80EE, which is not that important, but still let me just quickly tell you. Who is eligible, sir? Individual is eligible. What are the condition? Interest on housing loan will be allowed as deduction. Okay, the conditions are loan should be for the purpose of acquisition of the residential house. Okay, residential house. Second, loan should be taken only from a financial institution or housing finance company. Value of loan should be up to 35 lakhs. Value of the house, that is the purchase price of the house, should be up to 50 lakhs. Then loan should be sanctioned only in the previous year 16-17, that is from 1/4/2016 till 31/3/2017. Then while taking the loan, the assessee should not own any house other than the house on which the loan is going to be taken. So assessee should not own any house while taking the loan. Okay, what is the amount of deduction, sir? It is 50,000 rupees over and above the interest allowed under house property chapter. So in the interest from housing loan, you will first claim under section 24B under the head income from house property. Okay, however in self-occupied property, how much is allowed? Maximum 2 lakh rupees. Okay, over and above the 2 lakh rupees, whatever interest is there, you can claim here, that is under section 80EE, but here also the maximum limit is 50,000 rupees. So I told you, if actual interest is 2,75,000, first claim 2 lakhs under 24B under house property chapter, then claim 50,000 here under section 80EE. After this also you will have 25,000 as balance. You can't do anything about it, just leave it. Okay, next period, no maximum period till the repayment continues, it is allowed as deduction. Now let us come to the important section, that is section 80EEA, which is important because there is an amendment also. So interest on housing loan is allowed as deduction. So there also interest on housing loan, in 80EEA also interest on housing loan. Who is eligible? There also individual eligible, here also individual eligible. What are the condition? First condition, loan should be for the acquisition of residential house. There also same condition, here also same condition. Next, loan should be taken from financial institution or housing finance company. There also same condition, here also same condition. Next, the stamp duty value of the house should be up to 45 lakhs. There what is it given? the value of the house, that is purchase price, should be up to 50 lakhs. Okay, here it is given that the stamp duty value should be up to 45 lakhs. Okay, there it is given that the value of the loan should be up to 35 lakhs. Here nothing is given about the value of the loan. Next, the loan should be sanctioned between 1/4/2019 till 31/3/2021. Earlier it was 2020, now it has been amended to 31/3/2021. That is previous year 1920 as well as 2021. This section is applicable. Okay. So there it was previous year 1617. Here it is previous year 1920 and 2021. Next. Here also same condition, the assessee should not own any house before the sanction of the loan. Next, there the deduction was 50,000, but here the deduction is 1,50,000, and here also same. First you claim the interest, okay, in house property chapter, remaining interest you claim here up to 1,50,000 rupees. Okay, and if it is an LOP, you can claim the entire deduction in the house property chapter itself. But maximum loss that is allowed is only how much? 2 lakh rupees. Okay, so over and above the loss, if you are having any interest, then that interest you can claim here. Fine. Here also the period is the period till which the repayment continues. Now let us see section 80 EEB, that is interest on loan for purchase of electric vehicle. Okay, so if an assessee purchases an electric vehicle, and for the purpose of purchasing that electric vehicle, if the assessee takes any loan, okay, the loan should be from financial institution, and the loan should be taken between the period 1/4/2019 till 31/3/2023. Then the interest up to 1,50,000 is allowed as deduction till the repayment of loan continues. However, if this interest on loan is allowed anywhere else, it will not be allowed here. For example, if the electric vehicle is used for the purpose of business, interest on loan for the electric vehicle you would be claiming under PGBP chapter, correct? So if you are claiming deduction under PGBP, you are not allowed to claim the deduction here. So deduction will be allowed for one amount only one time. Okay. Next, section 80GG. Usually the people who are salaried employees will claim house rent allowance, okay, exemption under section 1014A. But what will happen to the people who are not salaried employees? They can claim the deduction here under section 80GG. So it is applicable to the people who are not covered under HRA. Okay. Now, if the accommodation is used for own residence, so what is allowed as deduction, sir? The rent paid is allowed as deduction, but there are some condition. First condition, the accommodation should be used as the own residence. Second condition, the assessee himself or the spouse or minor child or HUF should not own any other accommodation in the same area. Okay, in the same area. And then next, the third condition, the assessee should file a declaration of above along with the return of income. So first condition is what? The accommodation should be used for residence. Second condition, assessee, spouse, minor children or HUF should not own any other accommodation in the same area. Third condition, you should fill in the details along with return of income. Okay, if all the three conditions are satisfied, then the rent paid will be allowed as deduction. However, there are some limits. What are the limits? First one, actual rent minus 10% of the total income except section 80GG, or 25% of the total income, or 5,000 rupees per month. Whichever is lower will be allowed as deduction. Okay, whichever is lower will be allowed as deduction. Now let us come to section 80GGA. Okay, so usually if a person is covered under PGBP chapter, and if the person contributes for the purpose of scientific research or rural development program, they can claim deduction under section 35 or section 35 CCA respectively. However, if an assessee does not have any PGBP income, but still if they contribute to scientific research or rural development, okay, as the case may be, they can claim deduction under section 80GGA. Okay, so what are the condition? The condition is that Donation should be made for scientific, social, statistical research, etc. approved under section 35, and rural development program under section 35 CCA. Okay. However, deduction won't be denied merely because after the donation the approval was withdrawn. So once the assessee donates, he should see whether the organization is approved or not. But after donating, if the organization's approval was withdrawn, okay, the deduction won't be denied. Still the deduction will be given. Okay. Next, donation of more than 2000 rupees should be in any mode other than cash. So here also see, in any mode other than cash. Be careful with the wordings. Next, section 80GGB and section 80GGC. 80GGB and 80GGC both are for deduction for the donation to political parties. 80GGB is allowed for Indian company. Okay, the entire amount contributed to political parties is allowed as deduction. We studied in PGBP chapter that amount contributed to political party is disallowed under PGBP chapter, but it is fully allowed under deduction chapter. So under chapter 6A deduction it can be fully claimed. And what about 80GGC? 80GGC is assessee other than Indian company, because Indian company is covered under 80GGB. Then other than local authority, because local authorities are controlled by political parties. And then any artificial juridical person funded by the government. So all these three persons cannot claim deduction under 80GGC. What is the deduction, sir? Here also entire amount donated to political party will be allowed as deduction, and in both the sections there is a condition that the donation should be in any mode other than cash. Fine. Now let us come to important section, section 80JJAA, deduction for the employment of new employees. So first of all, who is an eligible assessee? Eligible assessee is any person to whom 44AB applies. That is, any person whose turnover is more than 1 crore and who is having PGBP income. Okay, turnover is more than 1 crore and having PGBP income. Sir, what is allowed as deduction? The total salary into 30 percentage. So total salary into 30 percentage for the additional employees is allowed as deduction for 3 consecutive years. Okay, so total salary paid to additional employees into 30 percentage for 3 years will be allowed as deduction. Sir, who are additional employees? In case of an existing business, the additional employee means increase in the number of employees, and in case of the new business, the total number of employees employed during the previous year will be called additional employees. However, the payment made to the additional employees should be via account pay check or account pay bank draft or electronic clearing system or any other prescribed mode like credit card, debit card, net banking, UPS, IMPS, RTGS, NEFT, etc. Okay. Only in this section we are seeing such wordings: account pay check, account pay bank draft. All other places we have seen only any mode other than cash. Okay, so learn to differentiate. Now, sir, who and all are not covered in additional employees? Four types of employees are not covered under additional employees. Number one, any employee whose total salary given is more than 25,000 rupees per month is not considered an additional employee. Second, any employee for whom the government contributes to pension scheme as specified under Employee Provident Fund and Miscellaneous Provisions Act. Such employees are also not counted as additional employees. Number 3. Any employee who do not participate in recognized provident fund will not be counted. It means any employees who participate in recognized fund only will be counted as additional employees. So it is compulsory for the additional employees to participate in recognized provident fund. Okay, and condition number 4, if the employee works less than 240 days, okay, and in case of assessee engaged in manufacturing of apparel, footwear or leather products, if the employee works for less than 150 days, then such employees will also not be counted as additional employees. However, if there is an employee, okay, who is actually employed during the last stages of the year, so he works for less than 240 or 150 days as the case may be. So if an employee works for less than 240 or 150 days but in the next year if he works for more than 240 or 150 days as the case may be, then he will be considered as a new employee in the next year. Okay, he will be considered as an additional employee in the next year. Fine. Next, exclusion from emolument. Emolument means what, sir? Salary. So what and all should be excluded from the salary? Any contribution made by the employer to any pension fund, provident fund, or any other fund for the welfare of the employee. And then, so that means employer contribution should not be counted. Okay. And then second thing, any lump sum payment paid to the employee at the time of termination of service. So if any bulk amount is paid to the employee during termination of service, such as superannuation fund, VRS, gratuity, etc., that also should not be counted in the salary. Okay. So other than these two, the total salary should be counted as salary. Next, sometimes what happens, some business will just open a branch, they will shift their existing employees to a branch and they will tell that they are new employees. Sometimes what will happen, some business it will reconstruct itself, it will put a new brand name and all the existing employees it will move to the new brand name and it will tell that they are new employees. So both of this should not happen. Hence what they have told, the business should not be formed by splitting up or reconstruction of an existing business. Okay. The business should not be acquired by assessee by way of any transfer or reorganization like demerger, okay, amalgamation, etc. It is given. Then last but not the least, if 80 AA deduction has to be taken, then you should take a report from an accountant. An accountant means chartered accountant, and such report should be submitted 1 month before the due date to file the return of income as per section 44 AA. Earlier it was along with return of income, but now amendment is there. It means 1 month before the due date to file the return of income under 44 AA. 44AB. 44AB only contains tax audit due date. So tax audit due date has changed. Similarly, here also there is a change. Okay. Now let's come to income based deductions. First, let us learn certain income based deduction. In income based deduction, I told you there are two types, certain income based deduction and normal income based deduction. So first we are going to learn certain income based deduction, that is 80QQB and 80RRB. Sir, what is 80QQB? 80QQB means deduction for royalty or copyright fees on certain books of literary, artistic and scientific nature. So if the assessee has written a book on literary or artistic or scientific subject, then if the person gives the right for the book and receives a royalty for the book, then the amount of royalty received will be allowed as deduction. Okay, so here deduction is allowed for the income that is received. Who is eligible? Resident individual is only eligible. What is the deduction allowed? Eligible royalty or 3 lakh rupees, whichever is lower. Sir, what is eligible royalty? If it is a lump sum royalty, then the total amount received will be the eligible royalty, and if it is not a lump sum royalty, then 15% of the value of the book sold will be eligible royalty. So first what you should do, first put the royalty amount as income, okay, then claim it as deduction. Deduction will be eligible royalty or 3 lakhs, whichever is lower. However, if royalty is earned from outside India, then make sure that the amount is brought into India in convertible foreign exchange within 6 months from the end of the previous year, or amount or the time allowed by RBI, as the case may be. Okay. Another condition is that certificate should be got from the payer of the royalty, that I am giving royalty of this much amount for this purpose, etc. Not a very important point. Next, section 80 RRB. This is royalty received for the purpose of payments. So if any royalty received by the payment and the receiver is a resident individual, then the assessee can claim deduction of royalty received or 3 lakh rupees, whichever is lower, as the deduction. And here also, if the royalty is received from outside India, the amount shall be brought into India in convertible foreign exchange within 6 months from the end of the previous year, or time allowed by RBI, as the case may be. Okay. And royalty includes the sale of patent, but it does not include sale of the products, okay, made using the patent. So if patent right is given and amount is received, it is called royalty. However, by using the payment, if a product is made and if that product is sold, then such amount received will not be called royalty. Now let us come to normal income based deduction. This certain income based deduction, that is 80 QQB, 80 RRB, you should link it with AMT concept. So if these deductions come and if the adjusted total income is more than 20 lakhs, AMT is going to be applicable. Fine. Now let us come to 80 TTA, that is interest on saving bank account. So any individual or HUF can claim deduction for interest received on saving bank account with saving a banking company, cooperative bank or post office. What is the deduction? Interest received or 10,000 rupees, whichever is lower. So whatever interest is received, first include it in the income under IFOS chapter and then claim it as deduction maximum 10,000 rupees under chapter 6A deduction section 80 TTA. However, if it is a post office saving bank interest, then you know that under income from other sources 3,500 rupees is allowed as exemption. So first you claim the exemption, then on the balance amount you can claim the deduction. So I told you earlier itself, let's say interest from post office saving bank account is 15,000. So first claim exemption under IFOS chapter 3,500. Balance how much? 11,500. Okay, which will be included in the gross total income. Now while claiming the deduction, you can claim the actual income, that is 11,500 or 10,000, whichever is lower can be claimed as deduction under 80 TTA. Okay. Next, section 80 TTB. 80 TTB is the deduction allowed for senior citizen. So if the assessee is a resident senior citizen, then interest on deposit, not saving account, it is given deposit. So the deposit can be saving account, it can be fixed deposit, it can be recurring deposit, it can be any deposit. If the deposit is with the banking company, cooperative bank or post office, then the entire amount will be allowed as deduction subject to the limit of 50,000 rupees, 50,000 rupees or actual interest received, whichever is lower will be allowed as deduction. And if the resident senior citizen is claiming the deduction under 80 TTB, then for the same amount deduction should not be claimed again in section 80 TTA. Okay, for one amount only one time deduction will be allowed. And one more thing, this 80 JJAA that we discussed right now, it is allowed even if the assessee is adopting the new tax regime under section 115 BAC. Okay.
Now let us move to the next deduction, which is section 80 CCH. So when I was discussing salary also, I told you that section 80 CCH, along with that I will also discuss the salary provision, and also there is an exemption provision that also we will discuss together. So 3 sections we are going to study together right now, which is about Agnipath scheme. Agnipath scheme. Sir, what is this Agnipath scheme? Agnipath scheme is a scheme which is brought out by the central government, where the central government will recruit very young people in the army. Okay, and after recruiting them, I think the period of the duration of them being in the army will be, I think, 4 years or something. I am not very sure about that, but the concept is that after recruiting, the central government will give them salary. Correct? Along with the salary, the central government will also contribute 30% of the salary to the Agniveer Corpus Fund. To the Agniveer Corpus Fund, and similarly, whatever salary is given to the people, correct, to the employee, 30% of the employee salary also will be contributed to the Agniveer Corpus Fund. And after the entire period is over, the total amount along with interest is given back to the employee. This is the concept. Okay, I am not going very deep into what are the features of the fund, why the government has brought this fund, that and all you can obviously browse in the internet. I am only discussing about the income tax aspect. So very simple. Let me discuss it in simple language. Firstly, I want you to pause the video and note down this table. Wherever you find space, please note down this table and then let me explain. Done? Okay. So Agniveer Corpus Fund, it is just a fund, like for example a provident fund, gratuity fund. Similarly, Agniveer Corpus Fund. In that corpus fund, the employee will contribute, employer will contribute. How much will they contribute? 30% of salary. Okay. Now, employee contribution is allowed as deduction under section 80 CCH subsection 1. So, under chapter 6A deduction, you can claim the employee contribution as deduction, just like PF. Okay. However, this deduction is only allowed in the old tax regime. It is not allowed in the new tax regime or default tax regime under section 115 BAC. It is not allowed. Now, let us talk about employer contribution. Employer contribution, first and foremost, you have to add to the salary head of income. This only I was talking about when I was discussing salary chapter. So, employer contribution to the Agniveer Corpus Fund will also form part of the salary under section 17. You get my point? After adding to the salary income, the same amount you can claim it as deduction under section 80 CCH subsection 2. Okay, entire amount you can claim as deduction. There is no limit. Fine. And this deduction is allowed even in the new tax regime. So it is allowed in both old tax regime as well as new tax regime. Fine. And now comes to maturity. And the amount of maturity including interest is exempt under section 1012C. Fine. So an exemption also can be claimed under both old tax regime as well as new tax regime. So it is a very simple concept. Now if you just go to this page and you read all the provisions, you will easily be able to understand. It is very simple, nothing complicated about this section. The concept is similar to the provident fund or pension scheme which we have already studied. Similar concept will apply here also to Agniveer Corpus Fund. Okay. So I hope you are clear.
So these were all the deductions. All the deductions, learn thoroughly and revise them again and again, by heart them, so that you are able to attend them easily in the exam hall. So keep learning, keep revising. See you in the next video. Till then, take care. Bye bye.